Imagine just for a second that you get the phone call of a lifetime. Like a private equity firm, or maybe your biggest competitor, just made this massive multi-million-dollar offer for the business you've spent your entire life building.
Right, the dream scenario.
Exactly. You are thrilled. I mean, you're ready to pop the champagne, call your family, and, start picking out colors for that sailboat you've been dreaming about.
Naturally.
But there's this massive catch. If you wait until you are actually signing the letter of intent to start planning your exit strategy, you've already lost a staggering chunk of your fortune to taxes. I mean, the champagne goes flat pretty quickly.
It really does. The reality of a major liquidity event is just, well, it's harsh. We see so many brilliant, meticulous entrepreneurs who build these phenomenal companies over decades.
Yeah, they know their business inside and out.
Exactly. But then they treat the actual sale of that company as a single, isolated event. And it is not an event. I mean, it is a multi-year process.
It's a totally different beast.
Oh, absolutely. A $5 million or $20 million sale is not just a bigger version of a $500,000 sale. It triggers an entirely different universe of tax complexities.
Okay, let's unpack this. Because the amount of money at stake here can literally be the difference between creating generational wealth and just handing a massive windfall over to the IRS.
Sadly, yes.
So, to guide us through this today, we are diving deep into a comprehensive framework provided by Davies Wealth Management. They are a fee-based fiduciary advisor located in Stuart, Florida.
A really crucial distinction, the fiduciary part.
Right, and we'll get into why that matters so much later. But this material comes directly from their focus on the 1715 Treasure Coast Financial Wellness podcast. Their guide is specifically about the essential tax planning strategies every Florida business owner simply must know before signing a deal.
It's mandatory reading, honestly.
Yeah. So our mission for this deep dive is to decode the incredibly complex tax landscape we are hurtling toward in 2026, break down how to actually preserve your wealth, and show you why you need to start the clock on your exit plan years before you ever sit down at a closing table.
And before looking at the specific mechanisms to, save your money, you really have to understand the sheer magnitude of the threat facing your proceeds.
It's huge.
It is. The absolute biggest mistake owners make is waiting too long to assemble their advisory team. The window between 12 and 36 months prior to a sale, that is the critical period. That's where the fortunes are saved.
Right, because if we look at the default scenario the source outlines, it is brutal. Like, let's say you get a $6 million offer.
Okay, a great offer.
Sure, but without any advanced planning, you are looking at a baseline 20% federal capital gains rate, but, and people miss this, you also have to factor in the net investment income tax.
The NI.
Exactly, the NIT, which adds another 3.8%. So you apply that combined 23.8% to your gain, and suddenly over $1.4 million is gone instantly. Just vanished.
Oof, gone. And the urgency to plan around this is compounding right now because of the 2026 reality check.
Right, the sunsetting provisions.
Exactly. We are facing the sunsetting of several key provisions from the Tax Cuts and Jobs Act. Currently, the federal estate and gift tax exemption is historically high. I mean, it's roughly $13.6 million per individual right now.
Which is a huge shield.
It's massive.
That's
Unless Congress intervenes on January 1st, 2026, that exemption drops drastically. It goes all the way back down to about $7 million per individual.
So wait, if you are a married couple, your tax-free shield basically shrinks from around $27 million down to about $14 million literally overnight.
Overnight, yes.
And anything above that new limit gets hit with a staggering 40% estate tax. I mean, planning a business sale is like baking a cake. If you wait until the cake is already out of the oven to try and add the sugar, it's completely ruined.
You can't just sprinkle it on top.
Right. The chemistry is already set. You have to mix these ingredients, these tax strategies, 36 months in advance to get the result you actually want.
What's fascinating here is that the government has literally put a ticking clock on the estate tax exemption in 2026. It practically makes pre-sale planning mandatory for high net worth families.
You have no choice.
You really don't. If you don't act within this window, you are actively choosing to let the IRS be your primary beneficiary.
Ouch. But the estate tax cliff isn't even the only trap. As I was going through the Davies wealth management materials, I realized there are all these hidden financial landmines based purely on how the assets inside the sale are classified.
Oh, the allocation issues.
Yes. Right, like ordinary income recapture. I think a lot of people just assume, oh, I'm selling a business, the whole thing gets that neat 20% capital gains rate.
That is such a common and very expensive misconception. When you sell, the IRS doesn't just look at the business as one giant blob. They look at the specific components.
Like what?
Well, let's say you own a manufacturing company, right? And you bought a warehouse full of heavy machinery 10 years ago. You've been taking depreciation deductions on that equipment every year to lower your tax bill.
Which is standard. The IRS allows that.
They absolutely allow it. But when you sell the business and the buyer pays for that machinery, the IRS basically wants their tax break back.
Wait, really?
Yes. They will recapture that depreciation and tax it not at the capital gains rate, but at your ordinary income tax rate.
Which could be up to 37%.
Exactly. Up to 37%.
Wait, look at the business you're sitting in right now. Like, I want to make sure you hear this. You could expect a flat capital gains tax and suddenly get hit with a 37% tax rate on a huge portion of the sale just because of your old warehouse equipment or inventory.
Yes. It happens all the time. And on top of that, your healthcare costs can skyrocket.
My healthcare from selling a business.
Oh, absolutely. We are talking about the Medicare IRMA surcharge. IRMAA stands for Income-Related Monthly Adjustment Amount.
Right, okay.
So Medicare premiums are tied to your modified adjusted gross income. When you sell your business, you get this massive one-time spike in your income. If that spike pushes you over the thresholds, which, by the way, start at just over $100,000 for a single person, your Medicare Part B and D premiums jump significantly.
Yeah, the source notes that high net worth sellers can see up to $12,000 a year in extra Medicare premiums.
It's a huge hidden cost.
And because Medicare looks at your tax returns from 2 years prior, a business sale in 2024 will suddenly cause your premiums to spike in 2026. It adds insult to injury.
Which is exactly why you cannot just accept the initial terms of a buyer's offer. The allocation of the purchase price is a fierce negotiation. The buyer wants as much of the cost as possible allocated to those depreciable assets so they can write them off.
But me as the seller.
You want the cost allocated to intangible assets, like goodwill, because goodwill gets that highly favorable long-term capital gains rate.
Okay, so the traps are everywhere. You've got the 2026 estate tax cliff, you've got depreciation recapture, and Medicare premium spikes. How do we fight back?
We need strategies.
Right. The guide outlines 7 major strategies, and I want to start with the ones that rely heavily on the element of time, specifically qualified small business stock, or Section 1202.
Yes. Section 1202 is arguably the holy grail of business sale tax planning. It was designed by the government to incentivize investment in small domestic companies. If your business is structured correctly, you can exclude up to $10 million or 10 times your cost basis, whichever is greater, from federal capital gains entirely. Entirely. Imagine selling your company for $10 million and paying literally zero federal capital gains tax.
Here's where it gets really interesting. QFBS is basically a VIP pass to avoid taxes entirely, but you have to stand in line for 5 years to get it.
The requirements are incredibly strict.
Very strict. It must be a C corporation, it must have had gross assets under $50 million when the stock was issued, and you must hold the stock for 5 uninterrupted years. And here's the kicker, most listeners right now probably have their businesses set up as LLCs or S-Corp for the pass-through tax benefits.
And that is the pivotal trade-off. If you have an LLC and you want that tax-free exit, you have to convert your entity to a C Corp today.
Which means double taxation, right?
It does. It exposes you to double taxation on your corporate profits in the short term. But if your company's valuation is rapidly appreciating and you plan to sell in, say, 5 to 7 years, the math often heavily favors taking the C Corp plunge today to secure that massive tax-free exit down the road.
But what if you don't have 5 years? Like, let's say a listener is burned out, they have a great offer on the table right now, and they want to exit in 18 months. They can't use QSBS. How do they pivot to protect their wealth right now without that VIP pass?
Well, if you can't eliminate the tax, the next best thing is to dilute it.
Dilute it, okay.
That is where an installment sale comes in. Strategy number 2. Instead of taking a $10 million lump sum and getting hammered by the highest tax brackets in the NIT all in one single year, you structure the deal to take, say, $2 million a year for 5 years.
Got it. So you are keeping your recognized gain lower in any single year, staying out of the highest tax brackets.
You are. But there's a significant risk involved here.
Which is?
With an installment sale, you are essentially acting as the bank for the buyer. You are financing their purchase of your life's work.
Oh, wow.
So if the new owner comes in, mismanages the company, and defaults on those payments, You hold the credit risk. You have to weigh the tax savings of spreading out the income against the very real-world risk of the buyer failing to pay you.
I see. So if I don't have 5 years for QSBS and I absolutely do not want the credit risk of an installment sale, like I want my cash now, but I'm staring down that shrinking 2026 estate tax exemption,
Right.
how do I move money out of my taxable estate before the sale closes?
This brings us to wealth transfer vehicles, specifically Strategy 3, the Charitable Remainder Trust, or CRT.
CRT. Okay, how does that work?
Think of a CRT like a financial airlock on a spaceship. Before you sign the sale agreement, you transfer a portion of your business interests into this irrevocable trust. When the business is sold, the trust is the entity actually selling those shares. And because the trust is tax exempt, it does not pay immediate capital gains tax on that sale. The airlock secures the asset before it touches the taxable atmosphere.
But wait, if I'm putting my business into a charitable trust, I am eventually giving the principal away to a charity. How does that make any mathematical sense for my own retirement? Wouldn't I be better off just taking the cash, paying the taxes up front, and investing what's left?
If we connect this to the bigger picture, it is really about matching financial mechanics with your personal values. Let's say you fund a CRT with $3 million of pre-sale stock.
Okay, $3 million.
You bypass the immediate capital gains tax on that, meaning the full $3 million is put to work generating investment returns immediately. Furthermore, you get a current year income tax deduction for the estimated value that the charity will eventually receive.
Oh, I see.
And then, the trust pays you a predictable income stream for life. The Davies Wealth Management Guide estimates that a $3 million funding could generate between $150,000 to $210,000 annually for your retirement.
That's substantial.
It is. And then when you pass away, the remainder goes to the charity of your choice. So you solve for retirement income, you lower your immediate tax burden, and you fulfill your philanthropic goals all at once.
That is an incredibly elegant solution. But let's look at another alternative for someone who maybe just wants to reinvest their gains. Opportunity zones. Strategy 4. The guide highlights this as a major strategy, especially in Florida where there are these designated zones along the I-95 corridor.
Opportunity zones are incredibly powerful if you already have a massive capital gain. The mechanism here is a strict 180-day rollover window.
180 days?
Yes. Once your business sells, you have exactly 180 days to take the capital gains portion of your proceeds and invest it into a qualified opportunity fund. This defers the tax you owe on the initial sale.
Which is nice, but
the real magic happens if you hold that new opportunity zone investment for at least 10 years. If you do that, all the capital appreciation on that new investment is entirely tax-free.
wow. So you defer the pain today and you completely eliminate the tax on the future growth.
Yeah.
That makes a lot of sense for someone who wants to keep their capital deployed in real estate or local development.
Exactly.
But let's shift gears to estate planning, because Strategy 5 in the guide brings up some intense acronyms, IDGTs and GCRATs. We know the estate tax exemption is getting slashed in 2026. How do these pre-sale gifting trusts actually work to protect a family's wealth?
Let's break down the IDGT first, which stands for Intentionally Defective Grantor Trust.
And the name sounds terrible, right? Why would you want a defective trust?
It does sound bad.
Yeah, intentionally defective sounds like grounds for a malpractice lawsuit.
Right, but it is actually a brilliant piece of tax code engineering. A flaw is purposefully drafted into the trust document so that the IRS still considers you, the grantor, as the owner of the trust for income tax purposes. However, the trust is drafted effectively enough that the asset is completely removed from your estate for estate tax purposes.
Okay, let me make sure I follow the mechanics of this. I set up this defective trust. My business is currently valued at, say, $2 million, but I know a buyer is sniffing around and might offer $10 million in a few years. I sell my business shares to this trust in exchange for a promissory note.
Correct. So now the trust owns the shares. A year later, the business sells to the private equity firm for $10 million. That massive $8 million explosion in value happened inside the trust, completely outside of your taxable estate.
Wow.
Right. It is shielded from that 40% estate tax we talked about.
And because it's defective for income tax, I am personally paying the income taxes on the trust's earnings out of my own pocket.
Yes, which is the secret weapon here.
Wait, paying taxes is the secret weapon?
Hear me out. By paying the income taxes yourself, you are allowing the trust assets to grow tax-free for your children or heirs. At the same time, you are legally burning down the size of your own taxable estate by using your cash to pay those taxes.
Oh, that's brilliant.
It is a dual-engine wealth transfer strategy. A GRAT, or Grantor Retained Annuity Trust, functions similarly by freezing the value of your estate today and transferring all the future explosive upside to your heirs virtually tax-free.
So what does this all mean for the year you actually sell? We've protected the estate with IDGTs, we've looked at ways to defer capital gains with opportunity zones, but what about the closing year itself? The ink is drying on the contract, and you are staring down that ordinary income recapture we talked about earlier from your old warehouse equipment. How do you offset that immediate tax hit?
You need massive tax deductions, and you need them fast. This is strategy 6. You aggressively utilize tax-advantaged retirement plans in the year leading up to the sale. A standard IRA contribution just isn't going to move the needle on a multi-million-dollar exit.
No, a few $1,000 won't help much there.
Exactly. You need to look at establishing a defined benefit plan or a cash balance plan.
Because with a defined benefit plan, depending on your age and income, you can legally stash away over $200,000 in a single year, right? And even a solo 401k allows for contributions of $69,000 or up to $76,500 if you qualify for the Secure 2.0 catch-up provisions.
Exactly. These accounts act as massive sponges to soak up that ordinary income tax liability. You are taking money that would have gone straight to the IRS at a 37% rate, and instead, you are paying your future self by sheltering it in a retirement account.
But the single most critical mechanical decision at the closing table strategy 7 comes down to the legal structure of the transaction, the handshake itself. Asset sale versus stock sale.
This is the ultimate tug-of-war in any business acquisition. Buyers almost always demand an asset sale.
Why is that?
When they buy the assets, the equipment, the customer lists, the intellectual property, they get what is called a step-up in basis. This means they can start depreciating those assets immediately against their own revenues to lower their own taxes.
Makes sense for them.
Furthermore, in an asset sale, the buyer does not assume your company's past liabilities, like, say, a pending lawsuit from a former employee.
But as the seller, you want the exact opposite. You want a stock sale, also known as an equity sale. You want to sell the entire legal entity intact. The buyer inherits your lower basis, they take on all the historical liabilities, and most importantly for you, you generally get to treat the entire transaction as long-term capital gains, completely avoiding that nasty depreciation recapture.
Yes, and this standoff is where deals often fall apart. But there is a hybrid compromise available for C Corp and S Corp called a Section 338(10) election.
Okay, that sounds like a tax code mouthful.
It is. This is a special election in the tax code that allows the transaction to be legally structured as a stock sale, which gives the seller the clean break they want. But the IRS agrees to treat it as an asset sale for tax purposes, giving the buyer the step-up in basis they demand.
That sounds incredibly complex to execute correctly.
It is, and this really highlights what we call the complexity gap. A typical business broker, who is highly motivated by the commission they get when the deal closes, might push you to just accept the buyer's demand for an asset sale just to get the deal across the finish line.
Right, because they want to get paid.
Exactly. They aren't running multi-year tax projections for you. High net worth sellers desperately need a fee-based fiduciary advisor because a fiduciary is legally obligated to act in your best interest. They coordinate with your CPA and your legal counsel to structure mechanisms like a 338(10) election to protect your wealth, rather than just rushing to close.
Which brings us to the final piece of the puzzle, geography. Where you actually live when you sign that paperwork. The Davies Wealth Management Guide is laser-focused on the Treasure Coast, and for very good reason. All the trusts and tax codes we've discussed so far are federal, but state taxes dictate a massive part of your final outcome.
The Florida advantage is profound. Florida has no state personal income tax.
None. Zero.
Zero. If you are a business owner in California and you sell your company for $10 million, you're facing a top state tax rate of 13.3%. That is over $1.3 million gone just to Sacramento.
Wow.
In New York, state and city taxes could easily strip away a similar amount. A Florida seller simply keeps that money.
But let's be real. You can't just rent an apartment in Stuart, Florida a week before closing, forward your mail, and pretend you're a local to dodge $1 million in California taxes. States like California and New York have aggressive audit teams. They will track your cell phone pings. They will look at where your dog goes to the vet. They will absolutely come looking for that money.
Oh, they definitely will. Which is why the domicile rule requires advanced planning. You must establish a bona fide Florida domicile 12 to 24 months prior to the sale.
So real ties.
Real ties. That means completely severing ties with your former high-tax state. You need to move your driver's license, Your voter registration, file for the Florida homestead exemption, and actually establish a physical primary presence. The audit trail needs to be undeniable.
And Florida isn't just a haven for income tax. It has incredibly favorable trust laws, too. They have modified the traditional rule against perpetuities to allow for a 360-year lifespan on trusts. That allows families to create multi-generational dynasty trusts, sheltering the growth of the sale proceeds from income and estate taxes for literally centuries.
Centuries, yes. But eventually, the wire transfer hits your account. The deal is done. And this introduces a completely new kind of risk, the post-sale reality. The biggest mistake entrepreneurs make at this stage is sinking their new liquidity into a single speculative deal, like a massive real estate development, just because they are used to taking big, concentrated risks.
Right. I mean, if you are an entrepreneur, you've spent your whole life betting on yourself. You are comfortable having all your eggs in one basket because you are the one holding the basket.
Exactly. But the game fundamentally changes once you sell. Fidelity's research consistently shows that diversification beats concentrated bets for wealth preservation. It is a very difficult psychological shift for a founder to take their chips off the table and submit to building a disciplined, diversified portfolio that generates reliable, slightly boring income.
And there are still proactive tax moves to make post-sale, right? Like if you step away from the business, you might enter a few years in retirement where your actual earned income is quite low. That is the perfect time to execute Roth conversion ladders. You convert your traditional pre-tax IRA funds to a Roth IRA, paying the taxes at your near temporary low brackets and locking in tax-free growth for the rest of your life.
It all comes back to treating this as a comprehensive timeline. The tax planning does not end at the closing table, and it certainly shouldn't begin there.
Let's distill this down. Time is your absolute greatest asset. Whether your business is worth $2 million or $20 million, the clock starts 12 to 36 months out. If you take anything away from this deep dive, it is that you must engage a fiduciary team well before you sign a letter of intent. You need to explore QSBS, trust structures like CRTs and IDGTs, opportunity zones, and aggressive deal structuring while you still have the leverage to use them.
The financial architecture of your exit is complex for sure, but it's highly navigable if you just give yourself the runway to build it properly.
But I want to leave you with a thought inspired by a brief mention in the Davies Wealth Management Guide about the identity transition. We spend years, decades even, meticulously planning the financial architecture of our businesses. We obsess over the valuation, the multiples, the tax mitigation, and the trusts. But do we spend any time at all planning the emotional architecture of our post-business lives? Think about it. When the deal closes, when your title is gone, the constant fires to put out stop, the employees no longer look to you for the answers, and your life's work is suddenly just a diversified portfolio sitting on a screen. Who are you? And what is the new currency that gives your life purpose?